thank you for joining us this morning. I appreciate it.
Thank you for having us.
Tell us a little bit about your role at SAP Ariba, please.
Sure, I'm part of our payables team. As we move forward with different payments and financing initiatives on a global basis, we help to make sure that those are valuable for our clients in treasury, procurement, and other functions.
Okay, great. So if we could advance the slide, we're going to leave this behind here, but could you tell us a little bit about the space of supply chain financing and what it takes to implement a program, a successful program?
Sure. So from a supply chain financing perspective, obviously it offers a ton of value, not only to corporates, but suppliers. But I think a lot of times people think it's just only a treasury-led initiative. I tend to think of it as the four amigos. It's certainly got to be Treasury, has to be heavily involved in this, but Treasury can't do this alone. It's super important to partner with other parts of the organization. This includes procurement, this includes accounts payable, this includes IT. So making sure that the different stakeholders are aligned in their successes goes a long way to making sure that happens. And I would also just add governance. You know, it's one thing to have the cross-functional alignment, but there's so many different things that are going on for a company and an organization. It's important to make sure that, you know, this has visibility at a CFO level, and at the end of the day, what gets measured gets done, and making sure that they are repeatable follow-up discussions across the organization so that the program is successful.
So I spent a number of years in my profession in corporate treasury as a practitioner, so I can relate to your comments about making sure you have the necessary parties involved across the organization. So if you were kicking off this type of a program, what would be your recommendation? Do you bring those parties together and build a committee of some sort?
Absolutely, in terms of bringing it. Usually it's very much treasury-led. But my first round draft pick would go be and sit down with the chief procurement officer or the VP of supply chain. And the reason for that is, you know, for a supply chain finance program to be successful, at the end of the day, the terms need to be moved out. And for that to happen, it's procurement who's going to go negotiate those payment terms with suppliers. And as you're negotiating those payment terms, it's not treasury, it's procurement. And you need to make sure that procurement is incentivized to do that, and procurement really understands it's not just a price discussion, but a value of capital. I would also bring, you know, accounts payable into this, and the reason is super important to have an approved invoice. The quicker that an invoice can be approved, the greater that working capital window. And yes, there's some technology setup to do, so need to make sure that your colleagues and friends in IT are participating in this process.
Okay, great. Well, we know that traditionally banks, large banks have been involved in the supply chain financing arena, but what other models are out there and available to corporates in terms of supply chain financing?
Yeah, so beyond banks, I think you're seeing a lot more in the financial technology space, and I think one that's particularly attractive is the multi-funder model, where, you know, at the end of the day, treasurers very much like their house banks or their relationship banks. And I think it's really important to take a giant step back and look at what everybody is good at. And a bank, very, very good at providing liquidity, lending money. Other people are very, very good at helping to facilitate commerce and also helping to do training and really negotiate those payment terms. So I think being able to offer and provide different types of capabilities where it works and your house bank can still do those things to provide the liquidity, and others can help to facilitate the transaction provides a competitive advantage.
Okay, great. What are some of the obstacles that you see within corporates as blockers to being able to, you know, maybe that's sort of sidelining them with blinders to these types of programs and implementing them in their organization?
Yeah, you know, one of the big myths that's out there is the accounting treatment. A lot of people think that this is debt on a company's balance sheet, and the short answer is it's not. It's just a trade payable, and certainly discussions for a different time, but it's been blessed by the different audit firms, whether it's here domestically or internationally. But a couple of other big pieces to come to, I'll come back to goals. And many times those goals, it's very treasury centric. And if you're going into this and procurement doesn't have a goal beyond price reduction, it's going to be super hard. So making sure, you know, we're in October right now, and now goals are being set for 2017. making sure procurement doesn't just have a price reduction goal, but they have a economic value add goal. And that economic value add could be, working capital related, it could be around inventory, it could be around cash flow, but procurement needs to get credit. They need to be motivated, incentivized, and compensated on the value they bring to cash flow.
So it's really a partnership in terms of the organization working as teams and maybe thinking about what the advantages can be for other areas within the organization, not just treasury or not just procurement. It's really a partnership.
Absolutely. It's very much essential that this is a team. Treasury is going to help drive a lot of this, but without procurement, you absolutely will not get success. And again, going back to the fundamental, procurement's going to be the one to sit down and have those negotiations with the supplier. And those negotiations are not just a price discussion, they're a value of capital discussion. And it's done so in such a way, not just with the salesperson from the supplier, but typically from somebody on the supplier's finance or treasury or credit side of the house.
And would you say that it's typically treasury that needs to help educate the supply chain education within procurement and sort of turn the conversation around from their perspective and educate them to how this can be beneficial, that it's not a one win, one loses type?
Absolutely, because if you think about supply chain financing, there's inherent conflict. A corporate trying to stretch out the terms, a supplier trying to get paid as soon as possible. But there's also a fundamental disconnect between understanding of that information. And a really good example, I had a client once tell me, if they were a utility company and they had the 20-story headquarter building, and if a storm was coming, everybody in that company would totally understand what that meant. How many people do we need to staff in operations, a call center, all of the details. But if that same person within that company went around those 20 floors and started yelling cash flow, the rest of the organization wouldn't really understand it. So it's super important to keep it kindergarten simple. We have some clients who they don't really put out so much the numerical goals, they put it in relationships that everybody can understand. So a good example of that, every day of DPO is worth one new store. So obviously it's different. Some companies think about it, this amount of money generates, this type of R&D pipeline. So it just depends on what your company is and some of your culture and goals, but being able to put it in ways that everybody can understand it becomes very, very important and valuable.
Okay, great. The European market seems to have been more active in the supply chain financing space for much longer than, say, the U.S. Can you talk a little bit about why that is and how that might be changing?
Yeah, so I think the Europeans started about 15 years ago, and they really embraced, I think part of it was driven by needs of cash flow and being a little bit more advanced in some elements. For example, the fact of a paper check in Europe is almost laughable. So they've embraced some of that early. But I think what we've seen in the last few years, especially since 2008 and some of the economic challenges, corporates really looking for ways to add value. And as part of that, Treasury very specifically, what can they do to add to the bottom line benefits of the business? And kind of rule of thumb is for every $1 billion in spend moved out 15 days, it's worth $40 million in free cash flow. So, think about what your company would have to do at the operating margins to achieve that. So it's an opportunity for Treasury to have a strategic impact on the company.
Well, that's a good lead into my next question in terms of, what size organization do you need to be? What type of credit ratings do you need to have? What's the right size for this market?
So obviously investment grade credit goes a long way and helps. Typically look for companies with over $1 billion in annual spend. The more spend, the more value. And the other big element of this is having a physical supply chain. So, if you're a manufacturer, a retail, a chemical company, somebody who actually produces, hard goods, and there's that movement of goods, those are typically good candidates for supply chain financing. Academically, could it work with others? Yes, but traditionally it's more of a physical supply chain than a services supply chain.
Okay, great. Can you tell us a little bit about what SAP Ariba is doing in this space and what makes you distinctive from the market?
Yeah, happy to. So SAP Ariba has for a long time been a procure-to-pay solution, and it really stopped at procure-to-invoice until a couple of years ago. And we've realized combining that whole transaction together across a global network has a lot more value for our clients. So what we've done is we've added payment and timing of payment options for our clients. And from a supply chain finance perspective, we are a big believer in that multi-funder model, being able to offer a lot of different choices and the services to help our clients be successful. But we connect those transactions to a network. So it's not a distinct supply chain finance platform. It encompasses sourcing, it encompasses buying, it encompasses timing of payment. And the value of that across a network, many to many, is very, very valuable for our clients, because at the end of the day, it gives not only our clients, but it also gives suppliers one place to go. Instead of having a different place to go for sourcing, buying, invoicing, timing of payment, and all of those different projects, change management, supplier enablements, being able to do that across one global network. That's what SAP Ariba is providing to our clients. And again, we don't want to compete with banks. At the end of the day, we've got 55 different funders, whether it's banks or non-banks, who can provide that liquidity to support a supply chain finance program.
Okay, great. What would you say is the implementation timeline for getting a program like this up and running, and how difficult, how much does the corporate have to be involved in terms of getting it up and running?
Yep, so typically it's about 90 days. And from a corporate perspective, one of the really nice things about supply chain financing is, yes, there's some work to be done at the corporate office, but not in the field. So for example, if you're a large corporate and you have 10, 20,000 employees, whatever that number is, those larger number of employees are going to continue to do what they do. They're going to source, they're going to buy, they're going to approve invoices, receive goods. But generically speaking, they really don't know when an invoice is approved and when it's going to be paid or how it's going to be paid. It's business as usual. The impact on the corporate is really within procurement and treasury. Treasury to help set the strategy, and procurement to actually do those negotiations with those suppliers. And really, again, it comes back to a value of capital discussion, not a price discussion. And those rollouts can be, like I said, anywhere from 90 days. It can go on for 6 months or longer. It depends how many suppliers are part of it. Typically, a large corporate has anywhere from 100 to 300 suppliers that are making up the majority of the spend, and that's where the majority of that value is going to come from. So that's going to be the focus area.
Okay, great. One last question before we open it up to the audience and wrap up. What is it like from the supplier side? What does it look like to them, and what is typically the reaction?
Yeah, so suppliers definitely appreciate the choice. So if you think about supply chain finance, there's inherent conflict. A buyer's moving out terms, a supplier's wanting to get paid earlier. And now, instead of just that supplier being forced to go to net 60, net 90, they now have options. And those options, beyond, there's no debt on their balance sheet, it's on-demand financing. They can choose when they want to get paid for which specific invoices, which is a big advantage. And typically, it's at a lower rate. So not only are they saving money, not only are they improving their DSO, their days sales outstanding, but they're having choice in a very easy manner without having to go originate a loan, deal with loan covenants or that borrowing. So it's a very, very supplier-friendly process to take advantage and trade some of their invoices, all of their invoices. We like to give suppliers a lot of choice in this process.
Okay, great. Well, thank you for helping us sort of highlight some of the points within this space in the market and dispel some myths. Alan, thank you so much.
Thank you.
I really appreciate it. It was great.
Appreciate it.
Appreciate it.
Thanks.